United Health Group is down another 11% on the day, following an over 50% drop since its all-time highs. I'm going to be explaining what I think of this company and if I think it provides value in the market today. Before deciding if this company is a good buy or not, it's important to actually look at the fundamentals of this business. If a business has bad fundamentals, regardless of the price, it's not going to be a good buy in the long run. I'm going to do a deep dive into the financials of this business. Despite an over 50% drop in the past few months, the business financials are actually quite good. So as you can see, this company has been growing exponentially over the past few decades, which shows that it's a compounding machine. The revenue has increased significantly, and if I scroll down here, I can see that the diluted shares outstanding are decreasing. So that means the company is buying back shares, which is always nice to see, especially at these prices. Looking at the cash flow statement, I always like to look if the company is generating positive free cash flow. On a trailing 12-month basis, this company definitely generated some free cash flow. Although it is a bit unstable, it's still good to see. Now, some important metrics to look for is the return on equity and return on invested capital. You want to see when investing $1 into a company that they could return a higher percentage on that dollar. So I can see here the return on equity is quite good and averages around 20%. I could also see the return on invested capital is also very good at an average of around 20%. The only problem I could see with this business is the operating margin and the net margin are quite low. So the operating margin is actually at 8% right now, and the net margin is at around 5%, which is quite low, but as it's a company in the insurance business, it's obviously going to be a lot lower than a company, for example, like Visa, who's extremely high quality and has margins of over 40%. So fundamentally, this company is actually very strong. You could see that all the metrics are quite good. The only downside I would see, and I mentioned this in my previous video, is just the margins. The margins are just extremely low. But aside from this, everything fundamentally is good of the company. So then it begs the question, why is this stock down over 50%? And this is where things get a bit more complicated, because we have a stock here that's beat the S&P 500 by a huge margin over the past few decades. But just because it had such good performance in the past does not necessarily mean it will perform as well in the future. So it's very important to look at the forward guidance when considering if it's a good investment or not. So there's obviously a couple of headwinds to consider when investing in this company. And the first one being is that the CEO actually stepped down recently. And his name was Stephen Hemsley. So Stephen Hemsley stepped down as CEO, and he's going to get replaced by a CEO named Andrew Whitty. And Andrew Whitty actually served as CEO previously. He actually served in 2006 all the way up until 2017. So I have the performance chart pulled up here on FinChat, and you can see all the way from 2006 up to 2017, he actually provided very good returns for the company. This was obviously also during the 2008 financial crisis, so there's that to consider too. But these returns are quite stellar. He's most likely going to be CEO temporary just because he's getting a bit old. But looking at his past performance, he seems to have done very well. Going to the most recent conference call on United Health, guidance has actually been cut. So there's no forward-looking guidance for 2025. I'm sure they're going to update this at some point during the year. We could only probably wait until next earnings report and see what happens. They also expect the company to return to normal by 2026. They expect to have a growth range, earnings growth range of 13 to 16%. The Wall Street Journal also released a report saying that this company is actually under criminal investigation for possible Medicare fraud. So I'm not going to go into detail on this article, but basically this company is being accused of doing Medicare fraud, and the DOJ is investigating this company. Now, investigations like this could take years. I know Visa, every major monopolistic company had one or two lawsuits over the years. So these lawsuits usually take years and they don't really add up to nothing, but it could be quite serious, especially since the CEO stepped down unpredictably and didn't provide much reason aside from personal reasons. And of course, United Health Group just completely denied these accusations. And they said the Wall Street Journal's reporting is deeply irresponsible, as even it admits that the exact nature of the potential criminal allegations is unclear. We stand by the integrity of our Medicare Advantage program. Now, it's important to note that this news is not necessarily new. It just came to public attention today, but the DOJ has actually been investigating United Health for quite some time now, all the way up until last summer, I believe. And diving a little bit deeper, one commenter here on this forum actually said that United Health didn't say they were not under investigation. They just said that they were not notified by the DOJ about it. Now, after all this information provided, do I think that United Health is a good buy at this price currently? I'm going to outright say that there's no yes or no answer to this question. When you're an investor, you want to place bets on the highest percentage of success. So you want to be betting on companies that have a 80-90% chance of doing good and a 10 to 20% chance of doing bad. You want to have a good margin of safety, but also have the potential to compound your wealth over time. So if the margin of safety is very high, it means that the company is most likely to do well going forward. But it's important to consider that the fundamentals of the company also matter. So if you have a high margin of safety on a company that's fundamentals are deteriorating, then you probably won't have the most success with that investment over the long term. So it's important to find balance of each factor. You want to have a good risk to reward, but you also want to have companies in your portfolio that compound over time, and not companies that you buy one year and sell the next. All that to say, a company could be extremely undervalued, but if you're not going to hold that company in your portfolio for the next decade, what is the point of buying a company like United Health if you could buy a company like Visa? And I elaborated on this point a lot in my previous video, but I find a lot of investors focus on the short term. And I personally do not want to hold a company for the short term if the company has low margins and bad fundamentals. So I laid out all the positives and negatives to consider with this company. Obviously, this company does have a moat. I said in my previous video, I do not think this moat is as strong as many people think it is, but this company does still have a competitive advantage, and it's obviously a very big company. It has over a $200 billion market cap at this moment of recording. It's down from almost $600 billion. But it's still a very, very big company. There is obviously the value aspect of this company. I think most people buying the company during the dip are just seeking value. This company does have good fundamentals. I would argue that every fundamental aspect of this business is quite good, except for the profit margins. So the margins are very low, but aside from that, the company is very high quality fundamentally. And of course, you have the dividend. I would never pick a stock just based off its dividend, but I know many income seeking investors would probably do this. It's not something I would recommend. Obviously, dividends do play a role in investing, but they shouldn't be a deciding factor of picking a stock. Now, obviously, there's a lot of negatives with this company. There's obviously the criminal investigations that have been ongoing with the DOJ. And the DOJ is going to have to prove if the company is doing fraud or not. And that could severely affect this company's performance. If they are being charged with fraud, that's a serious allegation and it should not be taken lightly. The lowered and unclear guidance also makes this company very unpredictable because we do not know what their guidance is going to be going forward. They did expect by 2026 for things to become normal again, but that's just what they're expecting. It's unknown if this is actually going to happen or not. You're also going to be investing in a company that's hated by literally everyone. The entire world basically hates this company. Customers hate this company. Politicians hate this company. Everyone pretty much hates this company. And me, when I try to invest, I always try to invest in companies like Costco, for example. Everyone loves Costco. And when you want to cancel your Costco membership, you could easily cancel it without any difficulties or without any problems. Costco has had extreme success just because customers love Costco. It's a great business. It's great for the customers. So I want to invest in companies that the customers enjoy buying their product and enjoy their product, and not companies that the customers just hate. You have obviously the political risk too. Trump signed a document to reduce the cost of Medicare throughout the country. It's unknown what effect that would have on the Medicare system, but it's a risk to consider. And then you have the unpredictability of the CEO. And because the CEO was replaced so many times now, and one of them was unfortunately assassinated, it provides a lot of unpredictability. You have to consider too that a very high quality CEO is very unlikely to step in the shoes of CEO of that company just because there is that fear of something bad happening. So now we get the valuation. I'm using a discount cash flow analysis, so I'm projecting out the cash flows of the future and getting a price based on that information. I put in some very conservative estimates. I put in a 5-year projection time span. I put in a metric growth rate of 8% of the free cash flows, and over the 5 years it's been at around 8%. It has dipped down significantly, so I put around 8%, which is very conservative, I feel. And I also put a price ratio of 15. The average is 23 over the past 5 years. I put in a 15 price ratio, price to free cash flow. You can see how we get a compound annual growth rate of 19%. Now, that means that the fair value is around $400, which is a significant increase from what it's trading at right now. But we could even price in some more conservative numbers. Let's say we want to do a calculation on earnings. We could also input a metric growth rate of around 6%. Just to put things in perspective, the growth rate over the last year was 8%. So we're putting a conservative 6. And then we're going to put the price ratio at 15 again. You can see that we're going to assume the dividend doesn't grow, and we're going to assume the shares outstanding only go down by 0.93%, which is the 5-year average. With those inputs, we get a compound annual growth rate of around 15%. Considering these are very conservative metrics, I think it's safe to say that this company could be seen as a good value play. So am I going to be buying United Health Group stock? And the answer is going to be no. I did mention this in my previous video, but I think that this company is just not as high quality as many people think it is. I obviously have a very concentrated portfolio. I run a portfolio of only 9 companies, and I'm very concentrated into only the best companies I could find in the market. And United Health Group just doesn't seem like the best company. It obviously has low margins, which I mentioned previously. It has decent fundamentals, but it's by no means the best. And I'm just looking for companies that provide higher growth rates, that have stronger fundamentals, and that aren't caught up in such controversy all the time. And I said this before, but I would not touch the stock at all. If you're a value investor, you might find the stock interesting, but I personally like high quality companies that grow over time, grow their intrinsic value, grow their price per share, grow their EPS, and all around outperform the market. And this company, although it has some good characteristics, is just not up to par with what I have in my portfolio, and I will not be investing in it at all. I would much rather invest in compounding machines like Google. Obviously, Google is priced a bit higher than United Health Group, but Google is just such a superior business than United Health Group that it would warrant paying a slightly higher multiple. I feel like this is a point a lot of investors miss, is that even if you're paying an extremely cheap price for a business, it's better to just own high quality companies and not businesses that underperform or have controversy baked into them. So I hope this gave a bit of insight on United Health Group, and I hope everyone has a great day.